Hello everyone, and welcome to your Glassnode video report for week 32, 2023. So Bitcoin is infamously volatile, and yet right now we are seeing some of the least volatile conditions that we have ever seen. So what we're really looking at today is this concept of a volatility crush, which in derivative speak is basically where the volatility, particularly in options markets, essentially the pricing of excess volatility just gets flushed out of the market, and the market's kind of lulled to sleep. It kind of goes very quiet, and it's just simply not pricing in a very explosive move. And what we're going to look at is, well, how frequently does the market go this quiet, and what does that really tell us about the way that options markets have priced forward volatility? So Bitcoin is known for volatility. Very few headlines exist saying that Bitcoin is a stable asset that doesn't go anywhere. It's generally quite the opposite. So to see the market go this quiet it's not typical, right? This is not the typical condition. It does happen from time to time. These things are never impossible. And we'll also try and contextualize when these kind of events happen. But really the next step is to go, okay, well, how are the futures and the options markets pricing this? Because that's where a lot of the trade volume is happening. And particularly with options, the amount of activity there, the open interest and the size has expanded significantly over the last 12 months. So now the options market is of a rival size to futures. So this is a new event, but it means that we can really look at both of these two different markets. So just before we get started, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And let's get stuck right into our analysis. Okay, so the first thing we're going to do is we're just going to set the scene with some big picture pricing models. We're going to come at this from two different angles. The first one is from the traditional technical standpoint. And the reason why we're going to look at technical models, what this chart here is looking at, we've got the 200 week, we've got the 200 day, we've got the 1 year moving average in green, and then we've got the 111 day moving average, kind of that faster signal. Obviously all very, very slow moving, lumbering moving averages. But the reason why we're looking at these is these are widely observed. These are the kind of metrics that lots and lots of parts of the market are taking note of. And generally speaking, markets are a bit like this self-fulfilling prophecy. The more people that look at the 200-day moving average, the more likely that the 200-day moving average is important. And it's kind of this, it feeds off itself. Now we're going to keep it really simple here. All I've done is I've used Workbench. We can use our if-then statement. And I've basically, there's been some questions actually I've got recently. How do you do an and or an or type statement using our Workbench tool? Well, the way that we've constructed this green bar down the bottom here is basically 4 different if statements. If price is above the 200 week, return 1, else 0. If it's above the 200 day, 1, 0, above. And then what we do is we multiply those together. So if all 4 of those, if price is above all 4 moving averages, it will be 1 times 1 times 1 times 1, and we end up with our green bar. So we can actually establish an and statement by using multiplication, and we can also do a similar set of logic with addition or subtraction in order to get some kind of an or statement. So anyway, what we're looking at here is note when we're above all 4 of these long-term moving averages. Following the 2018 capitulation, kind of as 2019 really kicked off, through most of the 2016 to 17 bull market, following the March 2020 event, and in our 2023 period. So we're kind of in that post-bear market hangover, and this is a very similar concept that you'll see is kind of weaved through this particular episode. Now, if we bring it back to the on-chain space, right? Let's just look at this from an on-chain analysis perspective. We can see we have very, very similar conditions for the realized price in orange, the long-term holder realized price in blue, and the short-term in red. And again, what we're looking for is just simply when is price above all 3 models, which otherwise means when is most of the market, whether short, long, or everybody, on average, is everybody in profit or in loss, right? That's essentially what we're looking at here. And you can see again, 2019 is flagged, post-March 2020 is flagged, and then again in our 2023 market. So there is actually quite a bit of consistency and confluence between these different models, and on-chain metrics quite often I find actually have quite a bit of semblance to what's going on in the traditional world. And really at the end of the day, it's because it's all describing psychology. It's all about market psychology. That is why technical analysis works, and on-chain analysis is just the same, looking at it through a different lens. Now, just to close out this kind of setting of where we currently are, we've got here our price performance since the prior cycle all-time high. Just a nice way to orient ourselves. Of course, the future is not any indication, but just trying to establish where we are. If we look at it now, If you've been following this channel for a while, you'll know that I generally say that the all-time high was actually April 2021. We have a great many metrics which really just signal that bear market sentiment started in that May 2021 sell-off. And really this, even though we hit an all-time high in November, it just didn't have the all-time high juice. It wasn't, it was an all-time high in price, but certainly not across every other metric. So we're actually going to consider the sentiment. That's really, to me, it's all about sentiment and psychology. And if we just take that as the all-time high, you can see we're actually in good company. Our previous two cycles, the 2015-16 and the 2019 recovery, 19-20, both of them were down at this current point. I think it's 840 days since the all-time high. They were 64 and 63% below the all-time high. We are currently 54. So we're actually faring just that little bit better. And if you actually compare those, the all-time lows were 80, or the cycle lows were 85% drawdowns in the previous cycles, and we got down to a 75. So we're about 10% better off than previous cycles, right? What does that mean? Well, not really that much. The more important part is that following that kind of 64 to 54% drawdown, you can see this was a long sideways period of stagnant. Right? And it was actually 6 months ahead for all of these prior cycles before the acceleration really started. Now, again, we don't know if that acceleration is going to be the same. It very well may not be. But at the very least, this kind of boring sideways pattern where just not much happens and volatility comes out of the market lasted for an additional 6 months, if history was any kind of guide, before anything really happened. Now, we can see this in our quarterly, monthly, and weekly price performance. 2019 was kind of this explosion off the bottom, and everyone was like, look, the bull market's back. It's all back in action. And then we just sideways chop. It was pretty painful 2019. I went through this myself. But really, you can see the scale of price was just nowhere near what it was, that kind of exciting rush out of the bottom. You can see the bull market, right? These are kind of on a similar magnitude. So 2023 opened with a bang, but it really has gone to sleep. So if we just put all of these things in context, our pricing models, our previous cycles, our price performance, all of these things are really describing this kind of end of bear market hangover apathy. Very, very much in this kind of phase where just not much happens. The market is still digesting the brutality of 2022, right? That whole bear market cycle. And again, if we take it back that this started actually, to my view, in April 2021, we are now talking about 840 odd days of kind of languishing price action. And it's been volatile and choppy. The market takes time to digest these things. And that's really what we're describing here. We have been in these cycles before, and right now it really does look like this kind of boring apathy. So that sets the scene for the volatility picture moving forward. So now actually zooming in and looking at realized volatility itself. I'm actually going to zoom out on this chart and look at this on a slightly larger scale. Now, this is our realized volatility, and we're looking at this across several different timeframes, everything from 1 week up to 1 year. Obviously, the much slower moving 1 year and 6 month type metrics. I would actually recommend jumping into the week on chain report to really dive in and see where the kind of what we delved into with the analysis. But the important thing is you can actually see that all of these volatility measures are dropping off a cliff, and they're actually quite low. When do we reach these kind of points? And this is actually an all-time low for some of the longer term 1 year style realized volatility. Well, we saw it following the March 2020 event in kind of that slow grinding hangover period where the market's trying to work out what just happened. We saw it right before the November 2018 sell-off. This was a 50% sell-off from like 6.5K to 3K in short order. And we also saw it immediately after that, right? We saw it following FTX. So kind of that post-capitulation type event. We saw several instances of this in this kind of languishing sideways period in 2016. And again, you're starting to see this consistency. We saw the same price models, right? Market was very similar back then as well. We typically see these extremely low volatility periods in the bear market hangover phase. That's really the kind of big picture that we're trying to get across. Now, there's a couple of other different measures of volatility. There's many different forms. Again, I'm a big fan of Confluence, and also some tools just resonate more with other people. So this particular one, we're looking at this 7-day, how far, what is the gap between the 7-day high and low of price, right? The other way you could look at this would be the Bollinger Bands. You get a very, very similar type analysis. But what we're looking at here is extremely tight trading ranges. Over the last 7 days, we've seen extremely tight ranges. If memory serves, about 3.6% or something like that. Now, I like to use these types of models, which is, okay, how many days in history have seen even tighter price ranges? And what we actually see is that it's less than 5%, right? Here's our 4.8%. It's about 4.9% of all trading days have seen a tighter range. So what that means is that, let's just say 5%, that means that 95% of Bitcoin's history has more volatility and larger price ranges than what we currently have. If we look at this on a 30-day standpoint, we're about 2.9% or 3%, which means that 97% of all months in this instance, because we're looking at 30 days, 97% of all months have higher volatility, more price expansion, larger price ranges. So we are talking about seriously improbable events. Bitcoin just does not go to sleep like this very often. So we're starting to set the scene. We've got a bit of macro context. It looks a little bit like previous bear market hangover phases. It looks like we have extremely low volatility. Certainly on a historical standpoint, there's just not that many precedents. We're going to run with a number of 5%, right? Just for simplicity, about 5% of trading days have seen less volatility. So we're talking about some serious extremes. We just don't see this very often. So the next step is to go, okay, well, how is this being reflected in trading activity? And in particular, derivatives are really where a lot of traders will express their view on volatility. And we're going to start with futures, but we're actually going to progress to the options space because options, obviously, that's where volatility and the kind of trade of volatility is best captured in the selling and the buying of volatility premium. So let's start with our trade volume. So for both Bitcoin and Ethereum, just to kind of paint the picture, this is a market-wide phenomena. Trade volume for Ethereum on futures is literally at all-time lows, 9.2 billion. Bitcoin is not quite at all-time low. It was a little bit quieter over Christmas, but it is not far from all-time lows. Now, this is the combined futures and options trade volume. Granted, in terms of trade volume, futures remain much, much larger. Open interest, those markets are roughly, not quite exactly the same, but a similar size now. But anyway, the market is languishing when it comes to volume. So again, we're in a very, very quiet period. There's not much volume, which means we're in a bit of an illiquid period. We're still dealing with this 2022 withdrawal of liquidity from markets, and digital assets are no different, and we're seeing this in the trade space. Another signal that we're still in this kind of risk-off type environment is actually the dominance between Bitcoin and Ethereum. Here we're looking at in terms of open interest and in terms of volume. So basically, let's just look at a binary market. We've got Bitcoin and Ethereum in terms of trade volume and open interest. We don't care about everything else. So purely on those two assets, which one is commanding the most trade volume on the left and open interest on the right? And you can see that through most of the 2021 to 22 cycle, Ethereum actually saw its dominance grow. On a volume basis, in the back half of 2022, it was pretty much 50-50. So for every dollar that was traded on a Bitcoin future, there was an equal dollar traded on an Ethereum future. In terms of open interest, Bitcoin has continued to hold that kind of 60-40 split around that same period, but you can see this is starting to widen out. We're now at about 65-66% dominance for Bitcoin, which means we're at a 35-34% dominance for Ethereum, and that's even more dramatic in the volume space. So this is really telling you that the market is looking for liquidity and it's having to come higher and higher up the risk curve. Bitcoin is seeing more of that trade volume happening on the Bitcoin side, and there is increasingly less happening on the Ethereum side, which generally speaking, that kind of signals a bit of a risk-off type sentiment. Generally, when you see risk-on behavior, money will flow further out on the risk curve. It appears that liquidity is being sucked higher up the risk curve, which speaks to a withdrawal and a withdrawal of liquidity and a risk-off type sentiment. So with that in mind, we're now going to stick just with the Bitcoin space because we've essentially established that most of the activity is moving towards Bitcoin. So it's going to give us a lot more clarity on what's really going on. It tends to be the trend setter in that regard. If we're looking at it from an open interest standpoint, we've kind of been pretty flat for about a month. There just hasn't been that much growth in overall futures open interest. It's been pretty flat. If we look at it in terms of futures in orange and options, here's what I was saying before. 2022 and 23 has seen options kind of explode up to the point where it's now rivaling the size of futures markets in terms of open interest. Now, we saw futures open interest peak right before FTX blew up. So part of this decline is actually, well, this initial decline certainly, is literally FTX's open interest going from whatever it was to zero, right? This was kind of the full collapse of that exchange. But we have seen liquidity getting sucked out of futures markets ever since. There has been a slight uptick in futures open interest in 2023, kind of the last quarter, but options have really kind of emerged on the scene as a preferred venue for getting exposure, right? Open interest is down from the peak, but you can see that we now have to really look at both of these two markets. And you will actually find that we have both for Bitcoin and Ethereum. We have futures, perpetual swaps, and options dashboards, which really covers a great scope of all the different tools that we have at our disposal. So the last part of this is trying to understand what are the trade opportunities that are basically keeping people in the market, because even though trade volume is deteriorating and falling off, there's still going to be opportunities in these markets, right? Prices still move. So what are traders actually doing? So the first thing to look at is our funding rates. And we can look at our funding rates, but also look at our calendar future premiums. Now, if we look at the dominance, perpetual swaps are still like 90, 95% of all trade volume. So the vast majority of trading activity is going on perpetual swap markets, kind of zero expiration futures. There's still a reasonable amount of open interest in the calendar futures, but they're much less used. But if we look at it from both of those lenses, the blue curve here is those calendar futures. Now, a trader can lock in roughly about a 5.3% yield by doing a cash and carry trade, buying spot, selling the calendar future, and then rolling that contract over and over again. Now, the thing that stands out to me is 5.3%, that's the US short-term treasury bill rate. So what we're basically looking at is the Bitcoin market is essentially adjusted, or because there's a risk-free rate for 5.2 or 5.5%, you've essentially got the futures market has corrected to offer a yield at 5.6% to incentivize that cash and carry trade. Now, the funding rate, which is in the orange here, is a lot more volatile. It moves a lot more with sentiment. It can even go negative. So if you're a market maker going short or long spot, short the perpetual swap, you currently earn 8.3%, which is, that's reasonably larger compared to the risk-free rate, but it reflects that additional risk and the dynamics and the volatility. So there is an 8.3% yield going on in the perpetual swap market, but it is volatile and there is more risk associated with it. And again, we've got to put this into context of the risk-free rate is up here at 5.5%. So that's kind of the ballpark that we're in. So with that said, futures markets, they're kind of offering similar yields to the risk-free rate, which is, a little bit unappealing. Are we kind of surprised that trade volumes are starting to deteriorate out? No, it kind of makes sense when you put all these things in context. So now let's turn to the option space. And this is where it's really interesting because we've obviously seen that options have exploded onto the scene. They now have a meaningful size in terms of their open interest. And what we now, and options are also where a lot of traders will capture volatility premium. So we've already set the stage that it's pretty low volatility right now. Now, historically speaking, I'm actually going to jump to this one here. This is our implied volatility chart. So this is what options markets are pricing the volatility. Now, for those who are not familiar with the options space, to have a strike price, Bitcoin price, let's just say 30,000 for round numbers. Let's say it's trading at 30,000 and someone's got a strike price for 33,000 to the end of the month. You don't need a great deal of volatility for Bitcoin to rally 10%, right? In order to get to 10% over the course of a month, there's a volatility of X. But if your strike price is 100,000, you need a lot of volatility. So you need a much higher volatility to get to these far-reaching strike prices. So for all of 2021 and 2022, we essentially had this period where it was between about 60 and 100%. And again, Bitcoin is infamous for its volatility. So it is historically traded in this 60 to 100% volatility range, except for right now. We saw the volatility drop off over Christmas, but then when we got the rally and the market started going, we actually kicked back up again, right? We moved back into this kind of 60 to 100% range. We have fallen off a cliff in the second quarter and into the third quarter of 2023. It really is collapsing. This is all-time lows in terms of implied volatility. It's actually less than half, between 24 and 50% vol, compared to what we saw through the whole baseline. So the big argument here is Bitcoin no longer a volatile asset? Or is the options market pricing not much volatility in the future, despite the fact that only 5% of all trading history has ever seen such quiet conditions? we're starting to see that the options market has been lulled to sleep. And it may in fact be kind of misunderstanding that if, again, Bitcoin may well no longer be volatile. But the 95% odds are that it wants to be more volatile. That's kind of the history that we've seen. And the question is the options market really kind of seeing into the future here, or has it been lulled to sleep? Now, the other side of that equation is if we look at our put to call ratio, higher numbers mean there's more demand for puts. Ironically enough, people are typically buying put options or downside insurance as the market is collapsing or has already collapsed. The right time to actually buy it is before the collapse. But you can see that we have seen a macro decline in the put to call ratio. And that's really telling you that whilst options in general on the volatility premium are quite cheap on a relative historical basis, put options are even cheaper relative to call options. So we're seeing this kind of interesting divergence where the market is really pricing in very, very low volatility, and particularly is kind of underweight on the put option side of the equation on a relative basis. And we can see this is the last chart we're going to look at on the 25 delta skew. This is essentially showing us how expensive put options are, being higher values for this metric. Higher values means that put options are more expensive than call options, and low values means that put options are very cheap relative to call options. And you can see we are plunging down towards all-time lows. So if we put all of this picture together, we've got this circumstance where there's about 5% of all trading history that's been this quiet and this dead in the Bitcoin market. We're in a very similar context, kind of that post-bear market hangover period. We do see this. So it's kind of more likely to happen at the current moment in time. Nevertheless, this is typically where it does happen. And our options markets in particular have been lulled to sleep. And put options appear to be very much not in favor. And we're really seeing that kind of cheapness on a relative basis of the put option space relative to calls. So certainly an interesting story, but kind of a nice way to show how we can look at some fundamental data, contextualize things using the on-chain space, and then move across into the derivatives to really look at how things are actually being priced across several areas of the market. So thanks for tuning in for that session, folks. Hopefully you found that useful. Do let me know if you have any questions or comments. I know that options and derivatives and these things, they're a quite complex topic for many folks, but there's also going to be many from the traditional finance world who certainly would understand a whole lot more than I do. So please do let me know if you have any comments or questions. More than happy to answer those, and I will see you in the next one. Cheers.